Hi folks, Doc Severson here for the Theonite Report for Thursday, March 2nd. Well, it doesn't seem to matter what index that we look at here. Here's the Dow Jones Industrials, lost about 112 with a dark cloud cover candlestick showing here. Here's the S&P 500 with just kind of an inside day setting up. Here is the Russell 2000 with another bearish inside day candlestick that ate up most of yesterday's profit. And here's the NASDAQ Composite, which is also eaten up about 50% of yesterday's move. So what does this all mean over the last 2 days, and what can I do to trade this type of market? Let's go back to the S&P 500 to answer that. Now, there's no certainty in a market like this. I think this is kind of unlike any other rally that we've seen, but really is it? And I guess we'll find that out soon, because we've seen rallies like this before over the last 20 years, not that many of them. We can see, obviously, the one back here in 2003, 2004, ended with a big, long consolidation, which was pretty much the entire year of 2004 before this thing started to rally again. Okay, we've seen other rallies like this. We've seen ones like in 2007 that started the instability, which led to the big financial correction here. We've also seen the moves out of the bottom in 2009, which has led to a very similar signal that we've seen here. That led to, as we know, a lot of instability in the summer of 2010, including the flash crash on May 6th of that year. Again, scary events. We've seen, these unbelievable moves like in 2013 into early 2014, which has led to the same type of signal here, which led to some instability here near the end of 2014. And now we get to this animal. I mean, this is a very, very rare signal when I see all of my time frames showing an extreme linearity signal. So you can almost lay a ruler down on the price action, any of these swings, and it would, substitute for a straight edge here. So this is just a very, very rare move when we see this much vertical movement, and it's actually accelerating as it gets into this. This is actually a very common type of pattern where we see an initial strong move off of the bottom, and then it gets into, I guess, what I call a very choppy middle area, which serves to generate more energy, and then we finish it off with what I call a parabolic tail to the upside, as it literally almost goes into an infinite slope to the upside. So is this rally done based on today's red candle? Well, I don't think so. I don't think the overall rally is done, but it's time for a rest. And every day that this continues to get lower and lower, the probability starts to build higher and higher and higher that we're going to see more instability in the near future. More than likely, what we should see is some type of larger range setup. So this can be very similar to what we've seen like around last year at this time, where we had this big choppy, well, actually, this time last year was right around here. Big choppy range that set up in the S&P. It was almost 100 points. So almost a 100-point range on the S&P. Imagine that up here at 2,400, setting up a 100-point range. You would look at this at some point forward in the future, if the price did set up with a 100-point range, and you would say, oh, well, that looks very normal. That must have been easy to trade. Well, let me tell you, when we see the first red candle from this of any size, today's was not of any, 14 handles on the S&P is really not that big. But when we start to see this build in earnest, a lot of people are going to be very freaked out and say, oh no, is this the bear market kicking in? No, it's not going to be that. It's simply the market taking a rest after some extreme, really out of bounds numbers here, where the market has just gotten into a condition where everybody feels the need to chase it. I mean, as of this morning, was the perfect condition for institutions to start taking profits and perhaps distribute into there, especially since we saw things like the market being the lead story on, of all things, the Today Show. Usually that's the kiss of death anytime we see the market actually being on the, not just the stock media, but the mainstream media. When the market hits the mainstream media, usually a sell-off reverses at that point, or if the market itself hits the mainstream media in terms of, hey, everybody else is doing it, why aren't you doing it too? that's usually a limiting factor. That usually marks a temporary top. Again, what I'm not looking for is for the price to do something like this. I think a lot of people are calling for that. I think I don't think there's any basis in fact in that. We have a strong trend here. What is necessary for this to continue is a rest. Think about you running up the side of a mountain. You can't do that indefinitely before you're holding your sides, gasping for breath. You're going to need to take a rest before you make that attempt on the summit. And this is specifically what we're going to see here, I think, in the near term as we get further into March, is more of a trading range. Now, let's go to part 2 here, is what can I do to take advantage of this trading range? Probably the number one thing that I like to do with a trade like this is to set up time spreads. In this case, this is a calendar spread. I love to set these things up because of a couple of reasons. First of all, we get a pretty good range to deal with here. So number one, we get a good range of profitability on the trade where we're not expecting it to really just stay in one point. We're expecting it to stay within a range. So to start with, this is a good trade for that. Point number 2 is really to think about the second condition here, is that this is a long Vega trade. So long Vega trades means that if the net volatility of these options ends up rising, especially that back month option on a trade like this, then what we'll see is actually the green line here, the expiration graph, will actually rise. The whole thing gets like picked up, like almost like you put a house jack underneath it, right? This is a little bit exaggerated, but still the point is true here, is that if you enter these with what's a low volatility condition to begin with, which is like now is a low volatility condition with respect to the market, then any movement to the downside, which generates more implied volatility, is going to make the overall range bigger, which is good. It gives you more room to work with. Now, the converse is true as well, too. You don't want to be entering these at the bottom of the range where implied volatility is spiked, because what will happen is on the subsequent rally, what will happen is this will shrink. So that's not what you want. You don't want shrinkage on a position like this. So typically when we see a rally up to here where we see the beginning of a range, this is an ideal time to put on a trade like this. Now, this also can be adjusted. We can turn a single calendar into a double calendar, so you can adjust for price movement either way, to the downside or to the upside. Of course, you do take more risk when you add on positions, when you bolt on adjusting positions like this. So keep that in mind, is that this is not meant for a big chunk of your portfolio, but this is a nice trade that works well if we see range-bound behavior. The other thing that I like about this trade is, if you think about the way that this is set up, we're selling and buying options right at the money. Unlike some of those old, way out of the money iron condors that we set up once upon a time when the market supported that. So the problem with those trades was they were great, allowing the price to do whatever it wanted to within that range, but it would take a long time for those options to decay because they were so far out of the money. So net here, I think that this rally will eventually transition into, and I'm thinking it may have started today, but I could be wrong with that, but eventually this will transition into what I believe is going to be a bigger range like this, and it'll trade within this range for some period of time. Could be as much as 2 to 3 months before this is ready to go again. And then anything could happen from there. If it transitions into this choppy range, it could actually break to the downside first before we get any additional upside, or it could just break to the upside from there. This is where we need to understand price action and trends and lower highs, higher lows, things like that, to understand which way that this thing is starting to lean before it exits that range. All right, folks, that is it for today's report. Thanks for listening, and we will catch you this weekend with the weekend report. Take care.